A high-fashion designer brand can sell a handbag for several $1,000s, a jacket for several thousand more, and a pair of shoes for an amount that could cover someone's rent for months. At first, the economics seem almost absurdly simple. Buy materials. Pay designers and craftsmen. Make the product. Put a famous name on it. Sell it at a huge markup. And, if enough people want the name, the owner gets rich. But that explanation misses the most important part. Because a global luxury brand has a strange economic problem, it cannot simply sell as much as possible. For most businesses, more customers are good. For a luxury house, too many customers, too much inventory, too much discounting, or too much exposure can actually damage the product being sold. And that product isn't really a handbag. It isn't a dress. It isn't even a logo. The real product is the belief that owning this particular object means something. That is what makes the economics of high fashion so unusual.
So how much money does luxury fashion actually make?
Take the basic numbers. In 2025, LVMH generated about $80.8 billion in revenue across its businesses. Its fashion and leather goods division generated $937.8 billion, with $13.2 billion in recurring operating profit, a margin of about 35%. Those are extraordinary economics. But compare that with another major luxury group, Kering. In 2025, Kering generated $14.7 billion in revenue, but its recurring operating margin was only 11.1%. Gucci alone generated roughly $6 billion of revenue and a 16.1% recurring operating margin. Same broad industry. Same expensive products. Very different economics. So what determines whether a designer brand becomes a money machine or an enormously expensive fashion project? The answer begins with something that doesn't appear on the product's price tag.
So why would a brand refuse to sell more?
A normal clothing company wants efficient production. If a shirt sells well, make 100,000 more. Luxury works differently. The brand needs to convince customers that the product is special, and that becomes harder if the product is everywhere. This creates a bizarre constraint. The company has to produce enough products to generate billions in revenue, but not so many that the customer stops feeling that the product is desirable. And that is why distribution becomes incredibly important. A luxury house can choose where its products are sold, which department stores receive them, how many boutiques it operates, how much inventory is visible, and how frequently products are discounted. In 2024, Gucci's directly operated retail network represented about 91% of its revenue. Wholesale revenue fell much faster than direct retail, as Kering became more selective about distribution. That isn't just a retail decision. It is control over the brand. If you sell through someone else's store, you surrender part of the customer relationship. You also have less control over presentation, inventory, and discounting. But owning your own stores creates another problem. They are expensive. A luxury boutique in Paris, Milan, London, New York, Dubai, or Tokyo isn't simply a room containing shelves. It requires prime real estate, architects, employees, security, inventory, maintenance, and an experience sophisticated enough to justify the price.
So what does it really take to make a single handbag?
And then there is the invisible machinery behind it. Designers, pattern makers, artisans, photographers, models, marketing teams, celebrity relationships, fashion shows, public relations, digital campaigns, supply chain specialists, store staff, regional headquarters, executives, legal teams, and years of investment before a product becomes commercially successful. This is where the first major economic paradox appears. The gross margin can be enormous while the business is still surprisingly vulnerable. Because the cost of producing one additional luxury handbag may be relatively small compared with its selling price. Cost of maintaining the machine around that handbag is enormous. And those costs don't automatically disappear when customers stop buying. That creates operating leverage. If revenue falls, the company may not be able to cut its costs proportionally. The store still needs rent. The employees still need salaries. The campaign may already have been commissioned. The collection may already have been manufactured. The fashion calendar does not politely stop because sales slowed down. And suddenly, a brand that looked incredibly profitable can become much less profitable very quickly.
So, what happens when a luxury brand loses its shine?
Gucci provides a particularly useful example. In 2024, Gucci generated 7.7 billion in revenue, down 23% on a reported basis and 21% on a comparable basis. Its recurring operating income was still around zero point 0.6 billion, but its operating margin had fallen to 21%, with Kering explicitly pointing to negative operating leverage from lower sales. Then the pressure continued. In 2025, Gucci's revenue fell to about 6 billion, down 22% as reported and 19% on a comparable basis. Its recurring operating margin fell to 16.1%. That is the chain reaction. A brand loses momentum. Customers become less excited about new products. Traffic weakens. Stores become less productive. Inventory becomes harder to manage. Wholesale partners become more selective. The company has to adjust prices, collections, distribution, and marketing. But now, the brand needs even more investment to recover. So the company spends money to create desire. And if the creative strategy is wrong, that spending can make the problem worse. Because fashion has another unusual feature. The product itself is constantly changing. A successful luxury brand therefore has to perform two contradictory tasks at the same time. It has to remain recognizable, and it has to remain new. Too much change, and customers wonder what happened to the brand they love. Too little change, and the brand becomes boring. This is why the creative director can have an economic importance that seems ridiculous from a traditional accounting perspective. A designer isn't simply designing clothes. They are helping determine what millions of dollars of inventory will look like, what celebrities will wear, what social media will discuss, what stores will display, and what customers will want 6 months from now. One creative decision can therefore travel through the entire financial system. And that's why a fashion mistake doesn't stay inside the design department. It can become an inventory problem, then a revenue problem, then a margin problem, then an investor problem, and eventually a management problem.
So, what are you really paying for?
But there is an even deeper layer. The most valuable thing a luxury brand owns may not be its factories, stores, or inventory. It may be the mental real estate inside the customer's head. Think about what you're actually paying for when you buy a famous luxury product. The raw materials matter. The craftsmanship matters. The design matters. But those things alone rarely explain the entire price difference between an ordinary product and a famous luxury product. The rest is accumulated meaning, heritage, recognition, status, association with celebrities and designers, cultural relevance, scarcity, trust, and the expectation that the brand will continue to matter. That last part is crucial. A luxury brand is effectively selling a promise about the future. When you buy an expensive watch or handbag, you aren't only buying what it is today. You're buying the belief that the brand will still be desirable tomorrow. That is why brand management is really a form of asset protection. And few companies demonstrate the power of this model better than Hermès. In 2025, Hermès generated 16.0 billion in revenue and 0 billion in recurring operating income, giving it a remarkable 41% recurring operating margin. Its leather goods and saddlery business alone generated about 7.07 billion. But Hermès isn't winning because it discovered some magical leather that costs thousands of euros. Its advantage comes from controlling a system, craftsmanship, training, production capacity, distribution, product design, pricing, heritage, and, importantly, scarcity. The result is an economic model where limited supply doesn't merely constrain revenue. It helps create demand. That's completely backwards compared with most industries. A semiconductor company wants more chips. An airline wants more seats filled. A streaming company wants more subscribers. But a luxury house has to constantly ask a different question. How much growth can we create without destroying what makes people willing to pay so much? That is the central balancing act. And it becomes even more important when the brand goes global.
So why not just sell everywhere at once?
Because global expansion sounds like an obvious strategy. Open stores in more countries, reach more wealthy customers, increase revenue, but every new market adds complexity. Different currencies, different tastes, different regulations, different tourism patterns, different economic conditions, different levels of brand awareness. And sometimes, a shock in one country can suddenly affect the entire system. LVMH's 2025 fashion and leather goods division, for example, generated 95% of revenue through retail rather than wholesale, with Asia excluding Japan representing a major share of geographic delivery. So even a global luxury house isn't simply selling everywhere independently, it is operating one interconnected network. And when demand changes, the consequences move through that network. Which brings us back to Gucci. The Gucci story is useful because the brand wasn't some tiny startup that suddenly failed. It was already one of the world's most recognizable luxury names. In 2024, its revenue fell sharply. Wholesale declined even more aggressively as Kering reduced its exposure to less selective distribution. And in 2025, the decline continued. Kering responded with management changes, creative changes, cost measures, and efforts to rebuild the brand's desirability and product authority. This is what makes luxury turnarounds so difficult. You cannot simply say sales are down, so lower prices. That might increase short-term demand. But it could also teach customers that the product isn't worth the original price. You cannot simply flood stores with inventory. That may increase availability, but it can weaken scarcity. You cannot simply cut marketing. That saves money today, but potentially reduces the cultural relevance needed to generate sales tomorrow. And you cannot simply replace the designer and expect the economics to repair themselves overnight. The brand has memory. Customers remember previous collections. Retailers remember what sold. Employees remember what worked. Investors remember the margins. The entire machine carries history.
So what does owning a fashion brand really teach us?
So, what does success actually look like? The best case is a brand that achieves something close to the Hermès or Louis Vuitton ideal. Powerful recognition, strong pricing, direct customer relationships, disciplined distribution, desirable products, and enough financial strength to keep investing during weak periods. LVMH's fashion and leather goods division still produced a 35% operating margin in 2025 despite a 5% revenue decline, demonstrating how powerful that model can be when brand equity and scale remain strong. The realistic, successful outcome is less spectacular. Revenue grows moderately. Some products become icons. Stores remain productive. Margins stay healthy. The brand doesn't need to dominate every trend. It simply remains desirable enough that customers continue accepting the premium. The negative outcome looks different. Hegel. Sales weaken. Inventory builds. Discounting increases. Stores become less productive. Marketing costs rise. Margins compress. Management responds with restructuring. The brand becomes less distinctive while trying to appeal to more customers. And the company finds itself spending more and more money to maintain something that customers increasingly want less of. The failure scenario is the most dangerous because a luxury brand can survive losing money for a while. What it cannot easily survive is losing meaning. Once customers stop believing that the name represents something valuable, raising prices becomes harder. Scarcity stops feeling exclusive. A famous logo becomes just a logo. And then the enormous economic machine underneath it suddenly looks much less impressive. That is the real lesson behind the economics of global high fashion. It isn't primarily a story about how cheaply you can make a shirt and how expensively you can sell it. It is a story about building an asset that exists partly inside people's minds, and then spending billions maintaining that belief without ever making it feel manufactured. The paradox is that the most profitable luxury brands don't necessarily win by selling the most products. They win by making the products feel like they are worth wanting. And once you understand that, the handbag, the The boutique, the fashion show, the celebrity campaign, and the designer all start to look like parts of the same machine. The machine is not really selling clothes. It is selling controlled desire, and the economics work only as long as the desire remains stronger than the price.